Welcome back, ML Capital analyst executives. We are here with our first pitch, actually, by Kabir. He's pitching e.l.f, which I think is a makeup company, correct?
Yep.
Cool, cool, cool. This is the first one we're doing. We want all of our analysts to see how Kabir pitches this, so you guys can do the same when you come up with investment ideas.
So yeah, my name's Kabir. I'm launching in just a little investing channel of my own as well. My main focus is always to do buy side research. I find that like I've read some sell side research reports before, and I always find that they're just a little bit lacking in conviction and evidence. So my goal here was to do like a initiating coverage type report where I'm just covering everything about the company, trying to learn everything about it from A to Z, and I'm just trying to then say if it's at a fair value. Because at the end of the day, the stock will trade. Eventually, if I don't like the price, I might like it. So my goal is, do I like the company, right? So yeah. So e.l.f. Beauty is a mid-size multi-brand beauty company, and they offer accessible cosmetic and skincare products. So their portfolio includes brands like e.l.f. Cosmetics, e.l.f. Skincare, which are their homegrown brands. And then they have some brands like Well People, Natrium, and Key Soul Care. So their main claim to fame is that they offer accessible beauty products that are also vegan, cruelty-free, and clean. And they are widely available at specialty retailers as well as mass retailers like Walmart, Target, and Ulta Beauty. And yeah, as you can see, this is their sales mix right here. 18% cosmetics, or 18% skincare, 82% cosmetics. Geographically speaking, they're mostly a domestic company, but domestic being America, um, with a little bit of sales in the UK and in Canada. And by distribution, most of their sales again are in store, with just a small portion being online. So here I just have a bit about the management here. The CEO has helped grow quite a few consumer brands in the past, as you can see. The marketing officer, again, she's worked at Shiseido, which is a huge Korean beauty company. And yeah, just some notable insights. 10% top 10 institutional holders account for over 50% of the holdings. And most of the stock is held by institutions, like most stocks, but still important to mention. And I think that also it's important to mention that they have good demographics for the inside their company, which should be expected for a company that's offering beauty, and it's targeting a younger demographic. So a little bit about the mission of the company. In their 10K, they state that their goal is to make best of beauty accessible to every eye, lip, face, which is what their acronym e.l.f. stands for. And yeah, they've fostered a culture where individuals are encouraged to express themselves, trust themselves, and yeah. So early history of the company is, I think, is pretty interesting. So it started by Joseph Shaman and Scott Vincent Barbara, and so they basically the story per se is that they were like in California somewhere, and some really uh, some woman drove by in her BMW, parked up, went into a dollar store, bought some like makeup, and then walked back out. I'm not 100% sure about the story, but and they basically got the idea that, oh, just because you are someone who pays a pretty penny for other things in your life doesn't necessarily mean you want to pay a pretty penny for makeup. And so that was where the idea was to create inexpensive but high quality makeup. And they started with 13 products. They started as a digitally native brand, but this was sort of like a technicality. They wanted to feature themselves in a magazine, and because they wanted to feature themselves in this magazine, they as a national retailer, they had to have a website. So they established their website first, making them one of the first digitally native brands. And they used that quite well. They launched a beauty blog called Ask a Shell, which drove a lot of traffic to their website in the early days, and it created sort of a small fan following, right? And then again, speaking to the vegan and the cruelty-free aspect of their company, it's always been a big part of them, and it's been sort of foundational with them, as you can see with the CEO, Joseph, who was awarded a PETA Trailblazer Award for the company's commitment to never testing on animals. In 2012, they started to sell their products in retailers like Walmart, Kmart, and Walgreens. And then they were acquired by TPG Growth 2 years later in 2014. And then the current CEO, Tarang Amin, I think, was appointed as the CEO. And then the founder, Joseph Shaman, he took a role on as in the board. And then in 2016, they finally went public. And they started being public with over 300 products and over $191 million in sales. So yeah, I'm just going to give you a brief overview of the beauty industry, right? So the beauty industry can be defined as four main categories: cosmetics, skincare, hair care, and fragrance. And in this particular report, we're going to focus on cosmetics and skincare because that is where e.l.f. Beauty operates. And in particular, they operate in accessible beauty. And we'll get to that in a bit. In terms of the total addressable market size, again, this is a McKinsey report. I don't know how much, like research McKinsey did into this, but they say that the global beauty industry generated 430 billion in revenue in 2022. And then skincare and cosmetics accounts for about 41 and 16% of this respectively. So what's interesting to me is that you'd think that cosmetics is a bigger part of the pie, but it's actually skincare, which is 41%. And what's interesting here is that the overall global beauty industry is 430 billion, and e.l.f. Beauty's last 4 quarters sales was just $765 million of revenue. Keep in mind that number doesn't include the latest quarter, but as you can see, it's a small fraction of the total domestic share. And then at the end of the day, McKinsey thinks that the industry is going to grow at about a 6% rate. So I think this is good because you have a strong industry tailwind that's going to continue to push the overall size of the market, and it makes sense, right? As it's intuitive when you have like a global population that over time, over the trend line, grows in their purchasing power. That should include consumer products such as makeup and skincare products. So I think that's a strong tailwind for the company. And yeah, just a brief breakdown about the Porter 5 forces. I'm sure it's quite intuitive. There's a high level of competition. There's a lot of acquisitions that are done in the space to maintain market share by large players like L'Oreal and Estee Lauder. And people are willing to try new brands, but they're very consistent with the brands that they choose to continue to use. So people will try, they'll experiment, but they really have to love a brand for them to really adopt it. In terms of purchasing power of buyers, keep in mind the buyers are not necessarily the end consumers at all time. So when you're talking about the customers, yeah, they don't necessarily have bargaining power per se, but they can vote with the products they purchase, so they can obviously force pricing to be competitive. And at the end of the day, majority of your customers are large retailers like Walmart, Target, Shoppers. So they do have bargaining power. And then there's always a threat of there's not a real substitute to makeup, or because makeup is just such a unique product. Cosmetics is complementary, but it's not obviously not a threat. And yeah, the bargaining power of suppliers is quite low as well, because the products that are being manufactured use very common materials like fats, oils, wax, emulsifiers. So let's talk about the competitors here. So there's one main type of competitor. There's a lot of small independent beauty brands that are not like a portfolio of brands, and there's like an endless sea of those. There's so many of those. But the main competitors we're going to talk about in this pitch is the large portfolio brands. And in some way, there are competitors, but they are potential acquirers as well, because e.l.f. Beauty's size. e.l.f. Beauty is, again, an $8 billion brand. If you look at, let's say, the largest player in this market, you have L'Oreal, which has a market cap of over $200 billion. So the potential is there, but we're not going to pitch this as a potential acquisition. We're just going to pitch this as a standalone company. Because of their size, they have a lot of bargaining power. Because of their size, they have the ability to acquire and finance acquisitions. And then they also obviously have economies of scale. e.l.f. Beauty in particular operates in the accessible tier. So what brands operate in the accessible tier? It's sort of complicated because you could argue that almost brands like L'Oreal or portfolios like L'Oreal and portfolios like Coty Beauty, portfolios like Unilever and Procter and Gamble, they have products in the accessible tier. But then they also have products in the mid-range tier, and then they also have products in the luxury and professional tier. So it's a bit all over the place. The reason I've included Shiseido and Estee Lauder as competitors is because they are comparable companies in the sense that they are a portfolio of brands, just like e.l.f., even though e.l.f. is a smaller portfolio. And yeah, so I just also want to quickly talk about some industry considerations. E-commerce has been growing in the industry a lot. There has been a huge trend of celebrities. We saw a huge trend in 2018 with Kylie Cosmetics. Selena Gomez has a line. Millie Bobby Brown has a line. There's like very few female celebrities that don't have a line of cosmetics or skincare products. So there's a very oversaturated space in that type of sense. There's a demand for vegan products that's growing. There's always been a somewhat of a demand, but it's growing more in recent years. And cosmetics, they're incorporating more natural and Ayurvedic products to appeal to customers. And one important change is that there's been a regulatory change in 2021 where beauty products that are imported to China that meet certain criteria can bypass the need of animal testing. And we'll get to why this is important later. So let's talk about the brand portfolio. The main brands that you need to focus on in this pitch is e.l.f. Cosmetics and e.l.f. Skin and Natrium. So e.l.f. Cosmetics, again, is still like, they don't release the exact numbers, but based on my estimations, around 75 to 80% of sales. e.l.f. Skin and Natrium, we do know, on the other hand, they are 9% of sales each. So this is why I said that these are the most important brands. Well People and Keys Soulcare, they were small acquisitions. Again, Well People was a $27 million acquisition, so very small, and it was a great attempt to do something, but I don't think it's really panned out and created enormous sales for them. It's maybe a drop in the bucket. Same thing with Keys Soulcare, which is a collaboration, a joint venture with Alicia Keys. But again, it's a drop in the bucket. What we're really focused on here is e.l.f. Cosmetics, e.l.f. Skin, and Natrium. Natrium acquisition is very interesting. It was an indie brand that was focused on skincare products that are compatible and affordable. And it was launched by a YouTuber, actually. So it was launched by a beauty influencer by the name of Susan Yara, who runs a YouTube channel with 1.5 million followers. But she actually fell into controversy with the launch of this product because she initially started to review the product without actually revealing the fact that she was one of the co-founders that launched this product. So there was a period of controversy, but since then the controversy has died down, and it's actually grown a lot since the end of that controversy. One of the biggest things about it is that it's grown like at an 80% CAGR year over year, and it's now close to $90 million in sales, which again justifies, I think, in my opinion, justifies the $355 million that e.l.f. Beauty paid for it, because it's about 4x price to sales. And at the end of the day, for a company that has potential for growth, I think that's a fair price to pay. So now let's talk about the products. This is the meat and potatoes of the presentation. This is what differentiates e.l.f. There are so many beauty products that are launched in this space. Why aren't other products able to capture the share that e.l.f. Beauty has able to been capturing? It's simple. It's because their products are amazing and the way they've branded themselves is amazing. So the products can be categorized into two different types: holy grails, which are like premium quality products, affordable prices, and a widespread appeal. Like, these products are essentially also known as dupes, and some brands consider dupes to be a bad thing. Like it's another word for a knockoff. But in the beauty industry, it's not a bad thing, because if you can get a product that offers luxury quality, high quality, but at an affordable price, then consumers are willing to buy that, and consumers love that. And so we have a little comparison at the bottom right here. So what I've done here is I took a website called Dupe Shop Beauty. It's a beauty blog, and there's other beauty blogs as well, like Allure, Refinery 21, Hype Bay, Glam, and Beauty Edit that have similar reviews. But I just broke down their comparisons between luxury products and e.l.f. beauty products. This is not what I'm saying. This is what a beauty blog is saying about their products. And I'm sure if you go on the internet, you'll find the same rhetoric being repeated. And also they have a core offering. So not all their products are the most high quality at the best price. Some of them are just a good buy in terms of price that offers some value still to the customers, right? So they're not going to blow you away, but there's still a core offering and a quality product. And then again, with the branding of their products, this is very important. So other products, like other companies like L'Oreal, Estee Lauder, other companies, they don't necessarily want to test on animals. They're not trying to test on animals. For the most part, you could say like, if I had to give it a number, I'd say like over 95% of these companies, for the most part, with their companies, with their products, do not test on animals. But there are certain areas where technicalities where there cannot be considered cruelty free, and for example, with China's animal testing laws. So there are certain, again, we talked about this prior in the pitch, but there are certain cases. For example, if you want to open an actual store, a physical location in China, you need to comply with China's animal testing laws. And because of that, even though companies like L'Oreal and Coty Beauty own products that are cruelty free, own whole lineups like NYX that is completely cruelty free, 100% vegan and cruelty free, they still cannot claim as a whole company to be cruelty free. You'll still see their products in the stores. You'll see some of their products on the shelves that say vegan and cruelty free, that'll have one of the two certified bunnies on them that indicate cruelty free, but they can still not really market themselves as a cruelty free company to the extent that e.l.f. can. And this is what's really beautiful about e.l.f. When people think about e.l.f., they think about a vegan, cruelty free, affordable, and accessible brand. They've made sure they've made sure to bypass all loopholes. If there's a mine in India that is using child labor to extract a certain glittery chemical that's used in makeup, e.l.f. Beauty has made sure from the start to not use that. If they've used ethical sourcing, certified trade factories for their products, and because of that, consumers they've built some brand equity with consumers. Again, clean natural ingredients is just like a breakdown of some examples of clean and natural ingredients that e.l.f. Beauty offers, and the benefits of those ingredients. And then I also these are some common drugstore brands: Maybelline, Revlon, CoverGirl, NYX, Wet n Wild. Out of all these brands, which one of these brands is like fully vegan? e.l.f. Beauty is. Other brands are not. Other brands may be cruelty free and clean, but they are not fully vegan. So I just thought that was something important to point out. The marketing is really like amazing. They've done a masterclass at marketing, and there's no doubt about it. They know their value proposition, and they don't shy away from it. They don't try to prevent themselves as a luxury beauty company. They present the value of their products in their marketing, and they're not afraid to use new and innovative marketing channels. They're one of the first brands on TikTok, and guess what? Because of that, they've had one of the most viral campaign in US history on TikTok, right? The eyes, lip, face TikTok challenge. They have unique brand collaborations, right? Who's thinking of collaborating with Dunkin', American Eagle, Chipotle? Not me. I don't know the thought process behind that, but it's worked out for them. They've gotten billions of impressions off this. Influencer collaborations. They like to collaborate with smaller influencers because smaller influencers tend to have a more authentic, or perceived as more authentic. And also they've done some product placements in the new Mean Girls movie. And then what I personally liked a lot was their latest Super Bowl commercial, where they used the cast of Suits, and they used Judge Judy, but they did like Judge Beauty, and so it's just like that is like sort of encompasses like the quirkiness of their marketing in a lot of ways. Um, so sales channels, again, we've talked about this before, but e-commerce now in fiscal year 23 is about 17% of their sales mix. So if you look before prior, it said 12%, and the reason it said that was because that is the fiscal year 2022. They have not released fiscal year 2023. So this is based on me taking the last 12 months and taking that and then as an average of total sales or dividing it by total sales and calculating the sales mix that way. So it's about 17% of their sales mix today, which means that they've seen some direct to consumer online growth. Now, this could present a risk in the future because at the end of the day, they their retailers have a lot of bargaining power, right? Their retailers are Walmart, their retailers are Target, their retailers are Ulta Beauty, right? These are huge retailers that have a lot of sway, and they make up a huge percentage of their overall retail mix. In 2018, they had some flagship stores. So they're one of the only accessible beauty brands to have flagship stores. But in 2018, they decided to move away from that strategy, focus on optimizing their shelf space in national retailer stores. And that's worked out very well for them. And we'll talk about that in a second as well. And the low churn e-commerce growth is, I think, is like really beautiful because they have 4.5 million Beauty Squad members, which is their loyalty program. This has grown 30% year over year. They have almost $2 million app downloads. And the thing I like about the reason I call it low churn is because 80% of website transactions are from loyalty. So loyalty members account for 80% of the transactions happening on a website. If you're seeing the e-commerce growth, this means that it's growing in a certain sect of people that are extremely loyal to this brand and measurably loyal. Maybe they're loyal in the retail sector too, we don't know. And 90% of app transactions are from loyalty. So that means, again, same thing, but with the app, just a little bit higher percentage. And yeah, I really like that because it shows a lot of brand equity, right? If I'm an acquirer, right, I want to acquire this brand so badly, and I'll show you why in a second. This is my favorite slide because it just really encompasses how successful they've been as a brand. According to this Piper Sandler Taking Stock with Teens survey, so this is something they presented in their latest, this is the source that they used in their latest earnings call. They are the #1 favorite cosmetic brand among teenagers. And honestly speaking, based on everything I presented, does it surprise you? It doesn't surprise me. They are one of 800 cosmetic brands. So this is what I meant. In a vast pool of brands, they're one of 800 to have 20 consecutive quarters of share gain, which in my opinion is extremely significant because it shows you like they've built themselves to be an accessible beauty brand, to be one of the cornerstone brands that you go to look for in a drugstore, right? When you go to Shoppers, I've went to a couple of Shoppers myself to take a look at this. I've seen e.l.f. Beauty as one of the consistently reoccurring brands alongside other brands like Maybelline, alongside other brands like L'Oreal, NYX, CoverGirl, Revlon. So they're establishing themselves as a staple, which I really like. They've doubled their share in the color cosmetics category. Keep in mind, I'm not 100% sure exactly what color cosmetics is defined as, but I think, again, the most impressive thing is the 20 consecutive quarters of net sales growth and the velocity of the growth, as you can see, which is increasing. Like, it's not that they had a lot of growth early onwards when their share was smaller. Their growth has been picking up as they've been picking up share. So I thought that was really interesting. So let's talk about the numbers, right? So the first graph breaks down their sales, free cash flow, and their net income. And you can see that their sales growth has compounded at a 25% CAGR, net income growth at a 46% CAGR, and free cash flow growth at a 28% CAGR. Keep in mind, their free cash flow growth in the latest quarter was a little lower than it was actually negative. And the reason it was negative was because of the Naturium acquisition. So because of that, it's lower. But if you look at the prior quarter, the free cash flow growth would have been even higher. And then again, the profitability growth again is something I really like because I think it shows that they have low operating leverage. So I think because they have low operating leverage, what this means again is that their fixed costs are a smaller percentage. Um, is that what it is? I think that's what it is, right? I'm not 100% sure. But yeah, because it's a smaller percentage of their overall costs, um, as they grow their brand, as they grow their business, their margins actually improve. And then the return on assets, the return on equity also improves. So you can see since 2015, what's happened to majority of the metrics. Again, not a lot of growth based on, as you can see in the trend lines, but a fair amount of growth that's worth mentioning. The balance sheet's super healthy. They have net cash. I think after this quarter, the Naturium acquisition, maybe they don't, but they still have very low levels of debt. Their free cash flow to total debt, again, is 131%, which is super solid. None of the other major brands have this type of, you could say, room to play because, again, they're much more levered than e.l.f. In terms of liquidity and efficiency, they have good cash ratios, good quick ratios. Their cash conversion cycle is a little weak. But again, they're a company that is consistently growing their inventories quarter after quarter to deal with the increasing sales that they're occurring. So in my opinion, it's fair for their cash conversion cycle to be a bit elevated. Earnings, again, look great to me. And their margins look great to me as well. Keep in mind, Estee Lauder is a luxury beauty company. So a company like Estee Lauder is having a gross margin of 70%. A company like e.l.f. Beauty that is offering accessible products is having a gross margin of 67%. That's beautiful to me as an investor. Again, EBIT margin, their net margin, their free cash flow margin. For what they're doing, it all looks good to me. The only companies that have better free cash flow margins and net margins, and EBIT margins, except for L'Oreal, are Procter & Gamble and Johnson & Johnson. And those companies, they offer so many low accessible consumer products that it's understandable. Like these are very well-run, stable, mature businesses. So it makes sense for them to have optimized their margins to the extent that they have. So I'm going to move on to the investment thesis. I'm just going to read this one so I don't mess anything up. So I just want to quickly, before I read it out, I want to point out that there's been a very strong correlation between stock growth and sales growth. So e.l.f. Beauty is a well-managed business which has been able to rapidly grow sales and take share from established accessible beauty players. The marketing efforts have been excellent at portraying a cohesive brand image and conveying the strong value proposition of their products. Moreover, despite being a growth company, e.l.f. Beauty's profitability, liquidity, solvency, and efficiency metrics are in line with much larger competitors. Despite all of this, at the current valuations, e.l.f. Beauty should only be considered for investment based on your belief of its future sales and subsequent earnings growth. So this is very important. At the end of the day, if you want to invest in this company, it needs to be based on your projections of future sales and your projections of future earnings, right? This company, keep in mind, even though it's mid-size, it's trading at a premium, and you'll see that in a minute. But let's try to walk through some of the catalysts for growth in sales and earnings. So you have industry tailwinds. If your industry is projected to grow at a compound average growth rate of 6% for the next 5 years, that's great, right? And you're taking share in that industry, or you're taking market share in an industry that's growing, in a growing pie. I love that. Substitution, because they're offering high quality products at low prices, that offers room for people in a sort of a recessionary fear economy to substitute from more expensive products to cheaper, more affordable products. And if you're looking to do that, e.l.f. Beauty is probably one of the best. So I think that's been helping them. Current market share trend. So if you just look at the trends we've been seeing, the 20 consecutive quarters of growth, and the velocity at which that the growth that is increasing, with their latest quarters having 70% growth, 80% growth in sales, that's beautiful to me. Again, I break it down here: 22% since 2014, since that's the information I can find on Backset. But if you look at the last 5 years, sales growth of 36% CAGR, EBITDA growth of 31%, and 49% EBITDA growth over the last 5 years. So I think given the small penetration, given the velocity at which they're growing, I think that like the past performance can be considered a catalyst for future growth. Then obviously economies of scale. So if you look at their sales growth, it's been slower than their EBITDA growth. And the reason I believe this is because I think that the way that their business is operating, it has a multiplier effect on the company's earnings. So a growth in sales, like over the long run, a growth in sales will lead to a growth in earnings that is greater than the growth in sales because of the low operating leverage. And then finally, you have the Naturium acquisition, which opens up the skincare area for them. The skincare area is still only 10% of their business. They're already small piece of the pie. So if Naturium can grow, again, maybe not at 80% CAGR as it has over the last 2 years, but if it can continue to grow, that acquisition will be a very successful one and it'll help them take share. And then, so I just have some metrics here where, okay, 41% CAGR sales growth. They have 10% of the color cosmetics market, 1.4% of the facial skincare category, and 13% of net sales are international. So you can already see that there's clearly room for the company to continue to grow its share of the pie. And yeah, so let's talk about the risks to the investment thesis. The first risk in a space as competitive as the beauty industry is obviously the competitors. L'Oreal at the end of the day is a company with $250 billion over $200 billion in enterprise value or market cap. So what that tells me is that this is the company that can compete. It has the money, it has the access to financing to compete. Their high trading multiple is a risk. As someone who's looking strictly at the stock, a bad quarter, right? A small deviation in their overall trend could lead to a huge sell-off, which presents opportunity, but it also presents a huge risk if you are a current investor. Retailers are another threat. If they continue to grow their direct-to-consumer line at the rate that they are, it could present a threat in terms of, it could present a threat from their retailers like Walmart, Target, Ulta Beauty, and Shoppers. And then smaller threats that I think aren't like too much of a problem is that there's been insider selling. But I think the reason they've had insider selling is because they've also had a lot of appreciation in their stock price. And the international risks are, again, a low threat because they don't have exposure to China. Excluding where their manufacturing is coming from, excluding the supply side risks, they don't have exposure to China on the sales side. And they only have 12% of their sales coming from international avenues right now. So lower Forex risk. So let's talk about the comparable comps. As you can see, if you're looking at comparable comps that do not consider the company's growth. So what do I mean by this? I mean comparable comps such as EV to EBIT current, or EV next 12 months, or EBITDA current, EBITDA next 12 months. If you're looking at price to earnings current or price to earnings next 12 months, right? What you notice is that e.l.f. Beauty is way overvalued compared to its competitors. But when you take into consideration, so let's try to use a metric where you take into consideration the growth. Let's give e.l.f. Beauty a little bit of let's play devil's advocate. If you consider the price to earnings growth, which is a metric that takes into consideration not only the price to earnings, but the next 12 months of growth that's anticipated, they don't seem to be too overly valued. So I think that's important to note. I think it's also important to note that companies like Estee Lauder and companies like okay, with hindsight, Estee Lauder is trading at a higher multiple right now because it's going through some weakness. But companies like L'Oreal, right, a strong, mature company, is still trading at like I would say a fairly high multiple, or the fact that it is a very established and mature brand. Maybe that's because it has the ability to acquire, and at the end of the day, it's always going to continue to grow. But I just think that's interesting to me. And again, I'm including Procter and Gamble. I'm including Johnson and Johnson in this valuation, but you have to consider that these two companies right here do not operate like 1, 2, 3, 4, 5. These five here, right? They are much more focused on consumer staple goods, which is very important to mention. So let's move over to the DCF valuation. So let's start by talking about the assumptions, right? I am assuming a almost 70% growth rate for my bull case for year one. And now you're probably looking at that and you're probably looking at me like, wow, this guy is extremely bullish and he's like overly optimistic on the stock. The reason I have this is because management is currently guiding to 67 or 69% sales growth in fiscal year 24. So they have a huge target. And you might be thinking that the management is over optimistic, right? But the thing is that the management can use their demand from retailers, which is a much more it's much easier to predict their demand from retailers. So they have their estimate for 67% sales growth has some level of rationality to it. So I'm assuming a 70% sales growth in the bull case, and I'm assuming the base and the bear are slightly worse. And then I assume that their sales continue to grow in all cases, but they slow down dramatically faster with the base and the bear case. And okay, I'll put this in perspective. If their current sales growth, like these numbers, if they compound, this leads to an approximate 3 times growth in sales over the next 5 years. So 3 times growth over the next 5 years, you need to think about that. Do you agree with that? Do you think that's possible? Do you not think that's possible? In terms of the cost of goods sold, the bull case is actually closer in all these estimates. The bull case is actually closer to what their reality is. But because I've had some insights from some industry experts I've talked to, where they've said that most mature companies in this space tend to target a operating margin of such and such. So because of that, I've made my base and bear case more conservative for the cost of goods sold in SG&A. And then the other most important assumptions here is that the current WACC for the company is 9.3%. Initially, it was 8.7% when I started this report. It changed to 9.3%. Nevertheless, I used a rate of return of 10.5% as a discount rate. And the reason was to build in a margin of error. So again, this isn't like the biggest margin of error to build in. You could argue that this is a little biased, like I should have done a 2% like I originally did, but I'm just going to stick with my 10.5%. And I also assumed a high perpetual growth rate of 4.5%. Why do I feel that this is fair? It's because at the end of the day, the industry, in my opinion, is one that's going to continue to grow for a very long time. The beauty industry globally is not a mature industry. And even though e.l.f. Beauty might not be able to capture every single market out there, at the end of the day, they're a company that will continue to capture market share, in my opinion. So I used a perpetual growth rate of 4.5%. Typically, you should use something like 2.5 to 3%, which is closer to inflation, long-term inflation. So yeah. And then tax rate, I just used, again, 20% of EBIT. I should have used EBIAT, but it's all fine. So this is the price scenarios I end up with. They don't look that appealing at all. You're looking at this and you're probably saying, wow, there's nothing but downside risk. In the bull case, I make my, like, I lose maybe 2-3% because I think the stock's at like 170 something right now. So you're looking at this, you're like, I don't want to invest in this. And that's fair. But the last thing you should, before we do that, again, this is what happens if you consider the WACC. This is the base case. This is what happens to the base case if you use a more, how you say, like a WACC that's closer to their actual WACC. So if I use like a 9.3%, I'd get something in between 185 and 138, which I think is like, if I take out the margin of error. Again, this is, you could argue this is a little biased, but I just wanted to present that. So this is basically my most compelling argument right now to purchase e.l.f. Beauty. So let's do a thought exercise. Let's say you take the EV to EBITDA, right? And which is currently at 55.5, right? And you assume that it falls to an industry average of 25%. What would it take for this EV to EBITDA? Let's assume that the share price does not change. How would the EBITDA have to grow for that multiple to come down, to be much more rational, and for you to essentially have paid a fair price or even a good price for the company? So your implied EBITDA growth in 1 year would have to be 122%. Your implied EBITDA growth over 2 years, let's say you say that, oh, that's not possible. 1 year, I don't think their EBITDA is going to grow 122%. Let's say over the course of 2 years, how much would their EBITDA have to grow for you to justify this valuation? 49%. Okay, that's a lot more reasonable. Let's look at what their 3-year growth would have to be, right? They'd have to grow at a 30% EBITDA growth for 2024, 2025, 2026 for you to sit here and be like, okay, now their EV to EBITDA multiple is much more rational, and I like it. And now, technically speaking, I've paid a fair price for the growth. So how do we justify this? Like, let's say hypothetically, I think that the 3 year is possible, but I'm not sure, right? Let's look at the past EBITDA growth. Over the last 5 years, their EBITDA has grown at a 49% compound annual growth rate, right? I got very lucky here with the numbers. I know you're looking at the numbers. For some reason, the 2-year growth happened to be 49%. And for some reason, the 3-year growth that you needed happened to be the 9-year average. I encourage anyone out there to calculate this number themselves just to be safe. But I'm looking at this and I'm asking myself, okay, if the current, keep in mind, this valuation method is throwing out relative valuation, it's not necessarily throwing out relative valuation, but it's throwing out the DCF model. It's throwing out intrinsic value. But if I assume that the market is willing to pay a similar multiple for this, right now it's trading at a multiple of 55. Let's say the market is willing to pay a 35 multiple for this in 3 years, right? Based on its growth. If it's able to grow at the levels at which it has in the past, from 2014 to 2023, then I'm essentially like, the price I bought in at, now the multiple I technically paid 3 years later is 25, right? But the market will still reward it for the growth, right? So I think that because of that, I think there's room for share price appreciation. And I think there's like a good amount of room for share price appreciation. And at the end of the day, this is something that, like, again, I'm new to my, like, not new, but like, again, still fairly new to my investment journey and my like investment research journey. So would I rather pay a high multiple for a excellent company, right? Or based on this valuation, a fair multiple for an excellent company, or pay a low valuation for a not so good company, right? Warren Buffett has a quote that or Buffett has a quote that time is the friend of a good company, but is the enemy of like a, I forgot the rest of the quote, but like a not so good company. So yeah, let me just conclude by saying it's a unique company that offers high quality, clean, vegan, cruelty-free cosmetic and skincare products at affordable prices. It has grown market share through consumer-centric marketing and strategic partnerships with key retailers. And I think that the commitment to providing tremendous value to its customers will continue to allow it to capture market share in an industry with robust growth opportunities. But at the end of the day, e.l.f. Beauty deserves only a consideration in your portfolio, contingent on your confidence on its future growth, right? So it's really a question of, do you see the growth that I personally see? Number one. Number two, do you think that somewhere in the short-term future, the market will punish the company, even like for a small period of time, and the multiple will fall, and you'll be able to purchase this company at a better price? Those are the two considerations you have to consider if you're willing to buy into this. And yeah, and then I just have my appendix here with my calculations and stuff.
Amazing, amazing, great pitch. Wow, you put a lot of time into that. We can tell.
It shows.
Yeah.
Fantastic job.
It was really
Fantastic.
good.
Good job.
So the whole time we were taking notes, just some
Yeah.
questions.
Honestly, just even before that, we had a lot of questions and a lot of notes that we wrote down. And by the end of the presentation, we kept saying, he just answered it. He just answered it. So
Wow.
very well thought out, very well fleshed out presentation. We do just have a couple things.
Yeah. We don't expect you to pull out numbers for us here because we're just gonna have some questions. Just give us your opinion on the matter, and if you have numbers, great. If you don't, it's totally cool. So, first thing I wanted to ask, because maybe you explained it and I didn't understand. When we talked about the Chinese regulations on manufacturing beauty products, I didn't understand if those were the regulations required to manufacture in China or to sell the product in China.
No, those are the regulations to sell in China.
So do you believe that they're gonna join the Chinese markets?
No, they have their CEO has said that they want to stay out of the Chinese market. They have tremendous opportunity to grow outside of the Chinese market without the Chinese market. And technically speaking, they're like, you could, if you're in China and you want their products, you can get access to their products, but through the online website. So you can, if you're in China and you go to e.l.f.beauty.com, you can order their products, and because of that, like, even though those products are going into China, they do not require the company to animal test their products, which is that regulation that happened in 2021.
So you can order online, e.l.f. in China. Cool.
Okay, fantastic. Couple pros that I noticed about the company as you were going along, starting with management. They all have a track record, a great history. They've worked in the industry for a long time and know how it operates. Another thing was, the competition, super competitive industry. And I was worried about their ability to actually capture any market share. You've mentioned, in the presentation, a 10% market share of the colored cosmetic industry. It would be great to know exactly specifically what that is. I don't know if I missed it, of the beauty or the cosmetic industry as a whole, what percentage are they?
I would use the McKinsey figure for the global. Let me see if I can get
465 million or billion.
They have two figures. They have one for the domestic market and one for the the market. So let's see.
So 430
the cosmetics and skincare categories in the US account for 18 and $24.4 billion of revenue. So based on that number, like cosmetics and skincare, 18 and 24.4 billion. Cosmetics is 18 billion in the US, like domestically. And if I took like the last 4 months, it's 4 quarters. Like, again, that 4 quarters needs to be updated, but if I took the 4 quarters accounting with the latest numbers in December, I would have like close to 1 billion. So I'd say like 1/18, something, whatever that fraction is.
Yeah. Which is still not like that's a good market share when you're competing in the same industry as Laurier and some of these massive companies.
Yeah, but the thing you have to remember is that this is like McKinsey doesn't like break it down by luxury, middle tier, accessibility. They don't do that. So I don't know exactly how much of that share they can capture. But the thing is that they are making a push internationally. So they have obviously Canada, UK, they've been there for a while. They've made a push into Italy recently, and it's been quite successful from their latest earnings call. And yeah, I just think that they have some room to expand internationally. And obviously the skincare market, they're not even a drop in the bucket for the skincare market.
Absolutely.
$24.4 billion. And skincare is only like 10% of their business right now.
You talked a bit about their leverage and that it was very low compared to other companies in the space.
Yeah.
What's driving that low leverage? Like, what are they doing differently?
So if you look at all these other companies here, Coty, Shiseido, Estee Lauder, L'Oreal, right? e.l.f. Beauty has they made their first real acquisition was Naturium. Their acquisition prior to that was Well People, right? Which is a $27 million acquisition. It was nothing. So because of that $355 million acquisition, they have some debt now that even though it was being paid off, there's a little bit now that's still they're very solvent with.
Yeah.
But companies like Coty Beauty, companies like Shiseido, Estee Lauder, L'Oreal, Procter & Gamble, Johnson & Johnson, they using leverage to grow is one of their biggest tactics because they acquire a lot of companies each year.
That makes sense. That makes sense.
Fantastic. Just a quick thing that we wrote down was about looking at future growth estimates, like on FactSet. I think you did something very similar where you actually took, and I also have to ask, when you bought that exact 49% and 30.5%, did you like find those numbers first and then create the estimates, or did you really create the estimate and then the actual case scenario was exactly spot on?
It was just spot on. Like, it's weird. I can like if you look at this right here. Okay, so this is like my DCF, right? And so what I did is I took the 5-year here, and I saw that it was where's the EBITDA growth? EBITDA growth, yeah, 49% CAGR, which is exactly what it was. And then I underneath it, I calculated the 2014 to 2013 number, and it was 31%.
Yeah, that's remarkable.
Wow.
Cool. And then so their gross margins is very comparable to the luxury brands, which is fantastic. You know, it's 67% compared to like 70 or 72. You mentioned that you don't want this to be like an M&A pitch, but I really feel like this is a company that's being looked at by some of these large parent companies for just a purchase, right? And when that goes through, then the share price, they're going to pay a premium for it, and that's going to cause a jump up. So I feel like that's actually a large consideration for this presentation, but I understand that you didn't want to, go into that because that's a whole other side of it. That's something to mention where I feel like that's a great opportunity there as well.
Absolutely. And the reason I think it's a huge opportunity as well, the reason I chose to stay away from it was like, okay, if I use that's a bull case, right? So I wanted to use the worst of the worst, right? Like, assume it's just a going concern. Yeah.
All right. Well, thank you so much for pitching it to us. Love the presentation. Super well done. Thank you so much. We're gonna talk a bit. I think we're most likely gonna try and find like an entry price for us that feels comfortable. I think right now it's trading in the 170s, so it's a little bit high.
I think you should definitely do that. Yeah, because at the end of the day, this is just like your first look at the company. For you to be like paying, if you want to pay a premium, you have to really know more about the company. Absolutely, I agree.
All right, thank you so much.
Cool.